And this is quite interesting here. It says it's the largest amount borrowed over a 2-day period since the COVID-19 pandemic. Friday, October 17th, 2025, Monaco 64, home of alternative economics and contrarian views. So it's been an amazing week in the precious metals. Am I excited? Well, not really, because I've told you that you need to keep an even keel. No matter what the market does, you can't get too despondent, you can't get too enthusiastic. You just gotta focus on the main objective. And what's the main objective? Well, I think is safeguarding the purchasing power and also, how can I say, the safety of your savings. And that's why I've been saying for 10 years here on YouTube, and I say that because I used to say it before that to friends, colleagues, and family, that you do need to have some physical money, i.e. gold and silver, outside the system. And I think it's getting to a point that it's not just really expensive to get some, but it's going to be physically almost impossible to get any. So I think that window is closing, unfortunately. I think there isn't a mania, as I said recently, unlike the what the FT thinks. And the public isn't rushing to gold yet. Yes, there's a few people, a small proportion that is, but I think this is the big money going into gold. We've seen the central banks, non-Western central banks, accumulating this stuff hand over fist the last 4 years. And I think the very wealthy as well, the billionaires or whatever you want to call them, the top 1%, they're acquiring this stuff. And I think a lot of them are waking up to the fact that you need physical gold and silver, that you can't depend on paper promises. And we're seeing that backfire, of course, on the LBMA. But what I want to talk about today is something that might even drive gold and silver higher, or the dollar and other fiat currencies lower. And that's a crack that seems to be appearing in the banking sector, especially in the small regional banks in the US. Of course, we saw that there was a crisis in this sector back in March of 2023. The Federal Reserve had to step in, and they came up with a new facility, special lending facility for the banks. And I think they might do that again. I received an email from someone today, and this is what he said. "Good morning, Mario. I hope you're well. I've attached some information for you from the Royal Mint website." The banking one is important, what he said here. And some analysts of the U.S. banking sector, which is getting some analysis of the U.S. banking sector, which is getting into trouble. Big trouble is just around the corner, he thinks. He thinks, they're going to bring back the bank term funding program, version 2. I think that's what they brought out when Silicon Valley Bank collapsed and some other banks. Yes, and he gave me this list of how they've performed yesterday and in the last week, and I'll show it to you right now. It's really red. It's really bad. There's a article in the FT as well this morning that I saw. It says U.S. regional bank shares sink on credit worries after fraud disclosures. Western Alliance and Zion's Bank disclose exposure to alleged fraud. Seems to be a lot of that going on now. We saw Tricolor go under, and we've seen First Brands go under. They couldn't find $2 billion. It just disappeared out of thin air. The CEO resigned recently. So were Tricolor and First Brands just the tip of the iceberg. And this could spread like wildfire. And to make things even worse, I saw this morning as well in the FT that the big banks are tapping the Fed lending facility in sign of short-term market strains. So normally financial institutions, they use their own repo market. So what they do is they provide, let's say, the lender with some treasuries that they have, and they get the cash, and then they buy back the treasuries a day later or a week later. That's why it's called a repurchase agreement or a repo agreement. But the rates for these transactions are going up higher than the Fed's repo facility. So these banks are going to the Fed. Why are the rates going up? Well, because I think all the cracks are showing in the banking sector, and banks are like skeptical to lend to each other, even short term, even with collateral. So I think this is serious. Banks tapped the Federal Reserve's short-term lending facility for more than $15 billion over the past 2 days in the sign liquidity pressures in the repo market that could drive the Fed to stop shrinking its balance sheet. Well, recently Jay Powell, the chairman, said that they would stop QT, quantitative tightening, or shrinking the balance sheet in the next few months. But let's continue. It says banks borrowed $6.75 billion on Wednesday and $8.35 billion on Thursday from the Fed's standing repo facility, SRF. And this is quite interesting here. It says it's the largest amount borrowed over a 2-day period since the COVID-19 pandemic. The SRF was introduced in 2021 as a permanent replacement for emergency repo operations launched by the Fed in the wake of market turmoil 2 years later. I'm not going to go through the whole thing. I just wanted to show you that there is problem in the system. But I will quote someone from Bank of America, a guy called Mark Cabana, head of U.S. rate strategy at that bank. And he says, and I quote, I think that there are now clear signs that the Fed has likely overdrained liquidity from the system. QT will end by the end of the year, but it could end even earlier. And this is really interesting what he said here. This is a loss of control of money markets, said Cabana. So I'll stop at that. I saw a post or a tweet by Rafi Farber, and I've tried to get him on this morning, but he's probably busy. But he basically sees that there's a problem as well. He thinks gold is telling us that, and I agree. And gold has been going up, of course, this year for a lot of other reasons, but this crisis that might be evolving in the banking sector could really trigger even more flows into gold and silver. And I'm not sure if there is a liquidity crisis, if we see something like March 2020 or 08 after the Lehman collapse. I'm not sure gold is going to drop that much. And even if it does, it will be very short-lived. And what Rafi thinks, and I agree with him, is that the Fed will then step in. They will not only stop QT, but they will start QE, and they'll print trillions. And some people might say, well, they've run out of ammunition. They've done it too much. I don't really buy into that because the Feds and other central banks' reason for existing, or raison d'etre, as the French would say, is to bail out the system when needed. It's the lender of last resort. And I think if they don't do anything, they will be in trouble. Their own existence will be questioned. People are going to say, what's the point of having a central bank if you're not going to bail the system out when it needs it? Of course, I think that would be a good thing, that they would go away. But the vast majority of people don't see things like me and you, hopefully. So, yeah, just to give you an example, the KBW Nasdaq Bank Index, that was down yesterday quite a bit. It was down almost 4%, 3.6%. Those banks that I told you about from the FT article, they were down substantially. Western Alliance and Zion's Bank, I'll tell you how much. Yeah, Zion's Bank was down 7% yesterday. It's down 13% this week. Western Alliance 8.5 yesterday and 10.8 for the week. The other thing that I wanted to touch upon is John Exter. I've spoken about John Exter many times. Some of you probably remember. He worked for the New York Fed. He helped found the Central Bank of Sri Lanka and the Philippines. And he happened to be a gold bug. In the 60s, after retiring, he started buying gold. And he did it through buying sovereigns. Of course, it was illegal at the time to buy physical gold in the US. That's how he got away with it. But he had this theory of liquidity in the system, and he expressed that through his inverted pyramid, which I have here. And I think he had Latin American debt, sovereign debt at the top, but now it's been adjusted to show derivatives. These are the riskiest assets are on the top of the inverted pyramid. Then you have non-monetary commodities, i.e. not gold or silver, private business, real estate, then corporate and muni bonds, securitized debt, listed stocks. I think I would add private equity to this. I guess that's private business. So, and then you have government bonds, treasury bills. And yes, we have seen a flow into treasuries. Yields have dropped. I still think it's a bad place to be. They haven't, their prices haven't gone up as fast as gold. And then you have paper money, of course, which it's like physical that you can hold outside the banking system. Then you have gold, and I would add silver to that as well. So could we be close to an event where all the liquidity drains down that pyramid towards gold and silver? Well, it certainly feels like it. Have you ever experienced market moves like we are experiencing right now? I haven't. I mean, I've followed gold since 2002, and I'm shocked at the performance of gold and silver. Well, shocked because I'm not really shocked because I expect this to happen, but it's just a shock when it happens. That's what I meant. So the thing is that liquidity pyramid, once that liquidity starts coming down the pyramid, you will see asset prices collapse. And I think the Fed will step in very aggressively. Not just the Fed, but all the other major central banks. And I wanted to show you as well a chart that is showing us that there is a trouble out there in the financial system, and that's the Dow Gold ratio. And it's been quite sticky over the last few years, and by that I mean it hasn't really accelerated lower, even though I agree with like Pierre Lassonde that we're going to go back to 1-to-1. And I even think we could go below 1-to-1, like a 1/2 to 1 or 3/4 to 1, which will mean you will need less than an ounce of gold to buy 1 Dow. But just look at this chart here. I mean, and I've got the lows from 1980, which was around 1. And the low from 2011, which was just below 6. And then earlier this year, we broke that trend line back in April. Then we rebounded. But look at it now. It's just like keeling over really quickly. And that's a bad sign. Bad sign for the stock market. Bad sign for the financial system, the banking system. So yeah, things are getting really precarious, I think. And yeah, I wouldn't be surprised if we see QE before Christmas. So that's what I will say here. And let's just quickly look at where things are. It's 7:45 a.m. London time. Well, gold is, I'm losing track of the price of gold. I never thought I'd say that. We're trading at 4,365, up $37. I think yesterday we were up another $100. The high's been 43.80, the low 42.77. Well, silver has kind of underperformed, even though we're trading above 54, which is like uncharted territory. Silver is only up a few cents, so there's still a lot of potential for silver. And I think maybe when the Fed steps in to add liquidity to the system, when we have a crisis, then silver will really take off relative to gold, or it could be before. I mean, I'm just speculating here. So the Dow futures, that Dow futures is down 240. So that Dow gold ratio I showed you, that's the price of gold, which is live, versus the Dow Jones Industrial Index. So that's from yesterday. So today the futures is down. So that chart would look even worse. The S&P is down 50 points and the NASDAQ 100 is down 225 points. So NASDAQ 100 underperforming, and I expect that to continue. What about the currencies? Yeah, I mean, the euro and the pound and the yen were up, and they're up this morning a little bit. So we need to think more, and that's the way I think, in terms of gold, because all these fiat currencies are going to be, well, they're already being heavily debased here versus real money. And yeah, so that's the way I see things. And with that, I'm going to wish you all a very good end to the week and a great weekend. Take care. Bye.